Okay, today we will proceed to Chapter 2. Chapter 2 is the role of financial markets and financial intermediaries. Today's agenda is the role of financial markets, the role of money, measures of money supply, interest rates and yields, transfer funds from savers to businesses, and wrap up. So the first thing we will look at is the financial cycle. As you remember the prior lecture, we talk about savers and borrowers. Borrowers can be companies, can be individuals, and companies which have projects and new ideas. And savers have supply of money, and they give their money to the companies, and companies generate wages and profits and interest on behalf of the savers, and they transfer the money to savers. And savers again make have supply of money. They have some consumption, but um, they have excess excess money, and they continue to give uh, the companies and the individuals, and the cycle just keep going. And the role of money. The money, anything is the generally accepted as a means of payment. It also defined as a medium of exchange. So what are other forms of money historically? It can be gold or silver or any kind of commodity. And what are the features of money is the should answer the following questions. Is it valuable, widely desired, portable, storable, generally accepted? And transferability and divisibility is very important. And store of value to the future is another feature of the money. And liquidity is ease of convert an asset into cash without loss. It's really important in financial markets. It shows the depth of the financial market, and also it refers the ability to sell an asset without affecting its price. The measures of money supply, the first one is M1. M1 means the sum of coins, currency, and demand deposits. Um, First, define the money supply. The money supply is the total amount of money in circulation, and M1 is the sum of coins, currency, and demand deposits. M2 is the sum of M1. M2 is equals M1 plus saving accounts and small certificates of deposit. M2 is not affected by shifting funds between checking and saving accounts, and M2 provides insights to the direction, extremity, and efficiency of the central bank's monetary policy. M3 is M2 plus large time deposits, institutional money market funds, short-term repurchase agreements, and other larger liquid assets. M3 is the broadest measure of the economy money supply, and it emphasizes the role of store of value. So interest rates and yields. Interest rates is price of money. It is the cost paid for use of someone else's money, and often expressed as a percentage term, which is the rate of interest. And the role of interest rate is allocate scarce credit, and short-term rates called money market rates, and the long-term rates capital market. And the money market refers year or less duration, and capital markets is greater duration, more than 1 year. And yield is the amount of return in percentage term for the owner of the stock or bond. So interest rates and yield. Yield curve is another term, another graph we should look at, and it is the yield curve is the term structure of interest rates. In the y-axis, we have we have yield interest rates, and in the x-axis we have maturity yield the maturity terms, which is the dates of the maturity. Don't confuse between risk and return figure. Return is, as you remember, the higher the risk, higher the return. But in the yield curve, in the y-axis, we don't have risk standard deviation. In the yield curve, we have in the x-axis maturity terms, and then y-axis yields in percentage term. Yeah. So let me clean here. So determinants of interest rate is a preference for shorter term, liquidity, debt default, risk, expectations of future rates, and the inflation rate. So this is a typical yield curve. As you see, the y-axis we have yield in percentage term, and the y-axis and the x-axis we have years, yield to maturity, and it shows U.S. government securities, T-bills, and treasury bonds in different the maturity, June 2005 and July 2017. And interest rates, okay, U.S. government securities such as T-bills and treasury bonds, and generally long-term debt implies higher rates, positive slope curve, as you remember in the prior slide, is a positive slope curve. And the higher the maturity, the higher the yield. So the maturity is 2017. This is the 2017 treasury bill, the treasury bonds, and 2005 is the lower yield. But occasionally, the yield curve could have been inverted, have a negative slope or flat. As you see, this is negative slope. So let's solve a problem. So Michael's credit card charges a 24% APR, annual percentage rate. On January 1st, he buys an item for $1,000 and he does not buy anything else on the credit card or making any payment. Assuming there are no penalties, fees, and minimum payments, how much does he owe at the end of the year? So APR is the annual percentage rate. It's simply simple interest rate, no compounding. Effective annual rate is the rate that represents the total interest accumulated at the end of the year, and it's compounding interest rate. So pause here and try to solve this problem. Okay, what is the solution of the problem? So this is the formula for the interest rate per compounding period. So if you go back to question, the compounding is monthly. So M is compounding. There we go. The M here is the number of compounding period per year. So we have monthly compounding means 12 time. We have 12. M is 12 because it's compounding monthly. And okay, so the formula is this is just yeah, this is the formula. So 1 plus effective annual rate equals 1 plus APR over M divided by M is our formula to find effective annual rate, compounding rate. Compounding rate. This is simple rate. Simple rate. Okay. So, okay, we have 24%. annual rate, but we have M compounding 12 times. So APR divided by M is 24% divided by M, which is 12, which is 12, yeah, which is 12 equals to 2%. So M12, effective annual rate plus 1 equals 1 plus 0.214, 24% divided by 12 over 12. And we did the calculation and we find the effective annual rate is 26%, 26.82%. So how much does he owe at the end of 1 year? So the principal is 1,000 and we are calculating the interest rate here. Effective annual rate is 26.82%, so we multiply this number to 1,000 and we find the amount that he owes. Okay. Number 4, transfer of funds from savers to businesses. And the income that is saved is substantially invested. Yes. And the process of investing creates financial claims. And 2 basic methods of transferring funds. It could be direct or indirect transfers. Direct transfers is a primary market. They call also primary market transactions. Firms and governments issue securities which can be sold directly to the general public through investment bankers. For example, IPO is primary market operation. It's a direct transfer, which is the firm and individuals. Firm of individuals. The firm goes to IPO and individuals buy stocks from the firm. This is direct transfer from the firm to the individuals. And secondary market is do not transfer funds to issuers of funds. Transfers ownership of securities among various investors. This means this time this transaction doesn't occur between firm and the investors. Let's say could be individual investors or like other companies. The companies can invest. The institutional investors can invest firms. But in this time, secondary market, people buy stocks each other. The investors buy stock each other. The transaction occurred between investors. So this is secondary market. Transfer of funds from savers to businesses, again, indirect transfers through financial intermediaries. So financial intermediaries, in other words, financial institutions such as commercial banks, savings and loan associations, mutual saving banks, credit unions, life insurance companies, pension plans, money market mutual funds, etc. And the funds are initially lent to intermediary, and intermediary subsequently lends the funds to other ultimate issuers. So in the middle we have financial intermediary, and through the financial intermediary, this money flows to borrowers, from lenders to borrowers. Unlike investment bankers or brokers, the financial intermediaries create claims to themselves. So they can create claims for themselves. The role of financial markets. So indirect transfer, we have financial intermediaries, we have savers, they have plenty of money, and borrowers, they're asking for money, they need money, businesses and firms, and the money just goes through the financial intermediaries to borrowers, and it's called, this transaction called indirect transfer. And borrowers can can have had the money, has the money, and they can transfer money to financial market, and this is called direct transfer. So finance is the process of transferring money from savers to borrowers, and the transferring returns back from borrowers to savers. Commercial banks, the most important depository institution, and the deposits are banks' primary source of funds, and they have assets and liabilities, and their assets are loans, and their liabilities are deposits. They borrow money from the savers and investors, and savers deposit their money, but in the financial institution, in the commercial bank, their assets are loans and their liabilities are deposits, and they have also equities. They have equity. And the primary liabilities are deposits. It includes checking accounts and saving accounts, and small equity base, and emphasis on short-term maturities requires rapid turnover. Their turnover is high, and composites of deposit, they have saving accounts, money market accounts, and certificates of deposit, which is very similar to saving accounts. And the CDS and CDs, they are tradable. The certificates of deposits are tradable. Okay, this is just a representation of assets as I showed here. Let's look at the commercial bank assets. They have cash, they have US government securities, they have other securities, and they have loans. It could be commercial and industrial, real estate, loans to individuals, interbank, and other loans. This is their total commercial bank total assets, 16 billion US dollar. And their liabilities is demand deposits, saving accounts, and certificate deposits, lifetime deposits, other borrowings, and liabilities. Should be equal. These numbers should be equal. And their equity. The $16 billion should be equal to their assets, right? Okay. Okay, what is required reserves? Required reserves increase the protection for depositors. So required reserves define the minimum amount that all banks must maintain as a reserve. Let's say 10% of the demand deposits, and either in the form of cash or deposits in other banks, especially in Federal Reserve. So they keep some minimum amount of money to Federal Reserve, kind of a protection for depositors. So they just park their money to a Federal Reserve and they secure the money. And the excess reserves define the difference between the bank total reserves and its required reserves. Bank total reserves and required reserves. This is required, this is bank total reserve. The difference is the excess reserves. Excess reserves. Okay, and after the 1930s, the Great Depression, the Federal Deposit Insurance Corporation, FDIC, established stability, and they created deposit insurance, which is up to $250,000. Other institutions, life insurance, pension plans, money market mutual funds, negotiable CDs, and U.S. Treasury bills, commercial paper, repurchase agreements, banker acceptance, and tax and anticipation notes. So wrap up. We talk about the role of financial market, the features of money, M1, M2, M3, interest rate, yield curve, Y and X. This is yield. This is the time to maturity, and the direct transfer and indirect transfers. Please read your notes, PowerPoint slides, Chapter 1, Chapter 2, and complete the mind tab exercises, quizzes, video reviews, PowerPoint, and flashcards. And all the exam questions and quiz questions will come from the mind tab exercises and quizzes, plus uh, also the book material. Thank you for your attention.